Okay, as I mentioned, my name is Eric Lee. I'm the Sales Director with Phillip Nova. In today's webinar, we'll be discussing the impact of government's policies to currency movement, and as well as strategies that we can use to trade them. Before we begin, I would like to do a sound check. If you can hear me loud and clear, just type yes into the question box. Also, during the webinar, you have any questions, do type them into the question box and I will address them during the Q&A session. Or if the question that you ask is relating to any particular slides that I am or topic that I'm talking about, please type them in, and as long as I see them, I will try to reply to them as soon as possible. Great. Seems like everyone can hear me loud and clear. So let's proceed. Just take note of the disclaimer shown here that the examples given here are for illustrative purpose only, and it does not recommend refer to any recommendations on my part or from Phillip Nova. Okay, a bit about myself before I begin. I joined Phillip in 2004 and is currently a sales director with Phillip Nova. Phillip Nova, previously known as Phillip Futures, is the derivative trading arm of Phillip Capital. So in Phillip Capital, we have the Phillip Securities that deal mainly in stocks, and then we have Phillip Nova that deals mainly in futures and forex trading. So I've been with Phillip and with this industry for 18 years. So throughout these years, I've been often conducting seminars and webinars, as well as providing my clients with market views and share with them on some strategies that they can use for trading and for investing in stocks, futures, and forex. So you can scan on the QR code if you are interested to get in touch with me to arrange for a one-on-one coaching session. Of course, nowadays, our coaching session, apart from just physical meetup, most of the time we also do the Zoom meetup due to the current the midst of the pandemic that we are still in. Okay, so presentation scope for today roughly divided into 4 parts. So over the next 1 hour, I'll be trying to share with you on the introduction to currency trading, the effects of inflation to the world currencies, as well as to understand the various government policies, be it fiscal or monetary policies, and the impact that it has on the currency movement. And at the end, I'll be sharing about some strategies that you can partake if you're interested to do some currency trading. So if time allow, I hope to also do some demonstration to you on our trading platform, Meta, on the Mt5 towards the end of the webinar. Okay, let's get right on to it on the introduction to Forex trading. By definition, Forex trading is really agreement between two parties, a buyer and a seller, to come to buy one currency with another at an agreed rate. So, but in layman's term, currency trading is probably one of the easiest topic that any one of us can be able to understand on, because it is part and parcel of our life. We deal with money all the time. Every time we go for a holiday or you want to do some online shopping, you will need to handle some form of currency conversion, either directly or indirectly. Indirectly will be via the credit cards or the bank system that do so automatically for you and I, right? So it's really to convert one currency to another. So the only difference when it comes to currency trading in this context is that we are not doing so because you want to go for holiday. We are not doing the exchange because we want to buy some gifts for someone, but we are purely doing so on a speculation basis. So in that sense, currency trading is traded out of a fixed contract. So that contract is for easy understanding or easy agreement between the traders involved. And the settlement of this contract is within 2 business days. This is purely just technical, nothing that we need to be concerned of at this moment. Okay, and the reason why currency trading is pretty popular among the investing community, that is really because trading opportunities are readily available for both sides of the trades, right? In fact, just by doing a currency trade by itself, it already means that we are doing a selling on the other side, because currency trading always comes in a pair. So you will always be trading, let's say, the USD against Sing dollars. So if we buy USD against Sing, so what it also meant is that we are selling Sing dollars. So so on the reverse side, if you trade, we sell USD versus Sing, we are also on the other way, we are buying Sing dollars, right? So the other difference that currency trading makes or allows us to do, especially when it comes to using a platform as Mt5, is that it allows us to place a hedge position. Hedge position meaning that you can have both a buy and a sell positions open on a similar contract. And both are not closed out until you have specifically indicated so. Perhaps later on, at the later part of the webinar, I'll do a little bit more illustration on this part about hedging position. But for most speculators or most currency traders, we really do not do any hedge positions, right? We are just doing pure speculation, buying at one price, and as the price moves in our favor, and then sell it later on at another price. Right. So one key difference for currency trading as compared to other instruments like futures or stock investing is the swap points. Because currency is actually the money that a country use. So the country is governed by the central banks, by the government, which then determine on the interest rate for the economic sake. So different countries will have a different interest rate set based on the strength of the economy. So as we do a currency trade, this difference in the currency, in the interest rates of these two currencies will then causes there to be swap points being charged or being accrued add-on to our positions. So let's take, for example, euro versus US dollar. So if an investor were to buy euro versus US dollar, right, for every 100K that he bought on every day, he will incur a $9 difference, and that difference is due to the swap points, because we all know that the euro has a negative interest rate, whereas over the past 6 months, the Federal Reserve of the United States have been increasing the interest rate pretty aggressively. So at this point in time, the difference of interest rate between the US dollar and the euro is maybe about 1.5 to 1.75. So that difference causes that to incur a charge to a trader who is having a long position or a buy position on the euro USD. So on the other hand, if the trader were to buy USD over euro, meaning that if he were to sell euro over USD pair, right, that trader would then earn $3.70 per day for every 100K positions that he holds. So this is what he'll be earning due to the interest rate difference as well. So the interest rate difference between the currency pairs is what we call the swap points. So you're basically swapping the interest rate of one country with another, right? And this has a huge impact on the currency movement, which I'm going to show it to you later on. Okay, there are some risks when it comes to currency trading. Of course, apart from the risk in the sense of the currency movement against our position, right? The main most important risk that currency exposes us to is a leverage risk, because currency is traded on leverage. For most currency trading accounts, the margin required for the positions you hold is about 5%. So meaning that if you were to hold a 100K position, then in your account you need to have at least 5K, $5,000 of funding in the account in order to be able to hold that 100K position. So that is what it meant by leverage. So leverage is a double-edged sword. It can work in our favor if you are right, but of course it can also work against our favor. So therefore, it is very crucial that each individual traders or investors have to adjust their own leverage accordingly. So do not just because they allows a 5% margin to be used, you fully leverage out to do the trading. That'd be very dangerous. So based on your own risk profile, based on your own investment strategies, we can adjust the leverage accordingly. Another risk, key risk that forex trading has is in liquidity risk. Now, liquidity risk is more acute on currency pair that is not so popular. By that we meant we actually have a term, we call it the cross pairs. So these are the currency pairs that are not denominated by the US dollar. US dollar, as we know, is a world reserve currency. Probably about 80% of the commodities or products traded around the world are settled in the US dollar. So US dollar itself is very liquid and also backed by the US government, by the US economy. So for beginners, usually we advise them to trade currency pairs that is denominated or paired with the US dollar. So then to avoid the liquidity risk. But even then, even if you were to trade currency pairs that is paired with US dollar, there will be certain incidents whereby liquidity risk is more acute. So this is when there is a prolonged holidays, or when there are major global events, like maybe a few years back we have the Brexit issue. So this Brexit referendum will cause that to be a liquidity issue, because traders or rather the financial institutions probably may not want to place on big bets right before any of these such major events that may cause a huge movement in the currency pairs. They may not want to put on the huge bets until they have see some results out of these events. So during these times, there may be some liquidity issues. So traders who are doing tradings will need to take note of that. Another risk of currency is a counterparty risk. And this counterparty risk is not really just for currency itself, but more for any products that is non-exchange traded. Currency is non-exchange traded is what we call an over-the-counter product. So therefore, it is not regulated by the exchange. But lucky for us in Singapore, I think the MAS, Singapore central government, is very stringent in the policy settings, and brokers like ourselves, like Phillip, are regulated by the MAS. So it is much safer than, of course, to trade or rather the counterparty risk is actually much lesser as compared to trading through via a foreign forex broking house. Okay, so now just some examples on how you do a calculation on the P&L. So I'm taking a Euro USD as an example. So over here, somewhere around early April, if an investor were to buy the Euro USD at 1.18, and later on, somewhere in mid-May, he sold it at 1.215, then the calculation is such that because it is a buy first, sell later, you use the and this is a profitable trade because the selling price is higher. You then use a 1.2150 minus 1.180, and the end result you multiply by your contract size. So if let's say the product the contract size you buy is 1,000, then the end result you multiply by 1,000, you get your profit of $35, and you then subsequently you will need to add or subtract the accumulated swap. So because this is a buy action on Euro USD, and just now as we have established, the Euro the interest rate is slightly lower. Even back in 2021, even though the US hasn't really increased the interest rate then, but the Euro is trading at negative, so definitely it's lower. So they may high chance that you will incur some accumulated swap, so there may be a minus of that to your P&L. So if the contract size you buy is 100K, you just use a similar formula, multiply by 100K, and also plus or minus of the accumulated swap points, and you will get your profit and loss. On the flip side, because as I mentioned just now, for currency trading, you can do sell action first before buying back. So if a trader is saying that the euro will continue to weaken against USD, he can then sell it first. For this example here, let's say a trader sold in early July at 1.18, and then later on, maybe somewhere in June this year, he bought back at 1.03. So because this is a sell action and it's a profitable trade because the price is lower, you then use 1.18 minus of 1.13, and the result you multiply by the contract size. If you're holding on to a contract size of 1,000, you multiply by 1,000 and you will get the result, which is $150, and you plus or minus accumulated swap points. As I mentioned, because this is a sell euro action, and somewhere in the middle, in the middle of the trade, in January to February period, the US dollar interest rate starts to increase due to the Fed's policy, whereas for the euro, they maintain it at a negative region. So thereby, for this trade, it is very likely that the trader will have accumulated swap being added on to his profit. Right, so if the trader were to trade a contract size of 100K, you use the same similar formula and multiply by 100K instead, and you'll get your P&L. The reason why I use $1,000 is because that's the minimum contract size that anybody can trade in using the Mt5 platform. So basically, the contract size is in the increment of 1,000. So for example, if you were to trade 1,000, 2,000, 3,000, and so on and so forth, right? Okay, notice the calculation there I mentioned is just you use the entry price minus the exit price and multiply by the contract size, and you only need to then factor in the accumulated swap. There's no commission involved because if you were to use the Mt5 platform, it is a zero com platform. So yeah, so it is more neat and clean for the trader to do the calculation on the P&L, and they need not be concerned with any additional cost to it. Other features of Mt5 is that it is USD settled. There's an auto margin call liquidation. There's an option for you to do a hedge trade and a hedge on a net mode. Hedge mode, as I mentioned just now, you can have a buy and sell position both open, and then subsequently you decide to close off, match off the contracts, the buy and the sell contracts to close it off. A net mode means that the system will just automatically, if you were to buy and sell the same contract, the system will just automatically net it off and calculate your P&L. Right, and but a neat features that MT5 has that other platform do not have is the automated trading using expert advisors. Towards the end, I will do a little bit of demo, and hopefully I can show you how the EA works, how the auto trading works. Apart from that, from Phillip, the MT5 on Phillip, you also have a third-party provider that provides a trade signal powered by Acuity. You can subscribe to our demo account for free to try out. The effects on inflation on the world currencies. Basically, when we talk about the currency movement, it has a lot, the impact has to be due to the economy itself. Because directly or indirectly, whether the economy is strong or weak, it will cause the central banks to adjust its interest rate, right? So thereby this adjustment of the interest rate, for example, if the economy is not doing well, the central banks will lower the interest rate, making it cheaper to borrow, and then therefore the companies will borrow funds to expand their business, buy factories. Consumer will then take on debt to buy on discretionary purchases like houses and cars, and thereby causes the economy then to expand. Right. On the other hand, if the economy is too heated, then what the central bank is worried about is that the overheated economy will cause there to be a high inflation, and thereby, in order to fight off inflation, the central banks will raise the interest rate, and this raising of interest rate will make it expensive to borrow. So companies who have plans to expand their business may probably think twice, because if they were to take on new debt here at a higher interest rate, they will need to incur more interest expense, which will eat into their P&L. So they may then delay their expansionary plan, right? Consumer like you and I, who will be thinking of buying a house or buying a car, may also put off our purchases because of the higher interest rate that we need to pay for it. So thereby, due to the reduce in the economic activities, the economy will then cool down. Okay, so this is theory. Of course, in actual fact, it is not so linear, right? There are many other factors involved, especially for what is happening in the world right now. We see that the high inflation that we are experiencing, it really started off or being sparked off by what happened during COVID 2 years ago, right? So it causes many of the economies to enter into lockdown, and many economies haven't really fully opened up yet. Some operating on a semi mode, some open up again, then close back again. So all these actions, right, actually in a way causes there to be a squeeze in the supply chain. So a squeeze in the supply chain, meaning that when we learn about economics, we know that the supply and demand will affect the price of the product. So when the demand is high but the supply is low, you'll cause the price to go up. So as price go up, that's where it causes there to be a high inflation. So that is one point or one reason why the world is experiencing high inflation. But there are other things as well, because to support the economy, many central banks or many governments all over the world then get on to be into more accommodative economic policies. Firstly, by lowering interest rate. Secondly, by printing out more money. to sort of to encourage spending, and also lastly by giving handouts to the citizens directly to help them tide through the tough times because of the COVID, right? So and all these actions cause there to be um, a huge money supply flowing in the economy, and this causes people to also to invest, to buy into assets, and also causes the asset price increase. So thereby, this will then also cause a high inflation. And the last hammer into, or rather the nail to the coffin to this high inflation that we're experiencing is, of course, that what happened during the Russia-Ukraine war, that causes there to be a supply disruption when it comes to commodities like energies, crude oil, natural gas, as well as food related commodities like agriculture commodities like the wheat and so on. Okay, there's a question asked about finance charge for overnight position. There's no finance charge, but there is a swap point, as I mentioned, which is the difference between the interest rate between the currency pairs. So thereby, if you were to short Euro USD, in fact, you'll be earning the swap points at this moment due to the huge difference in the interest rate. So there's no finance charge. Okay, so that is the situation right now when it comes to the inflation that the world is having. That's why as I mentioned, it's not as linear as what the theory we learned in the textbook show. Now there are many factors affecting it. So the economy right now, what we are facing is that we have a potential of having high inflation, and yet at the same time the economy starts to cool, but the central banks are not able to reduce interest rate due to the high inflation. So that in the investing community, of course, there is some fear that, or there's some worry that the world may enter into a state of stagflation, meaning that we will have high inflation and yet a lousy economy, right? So okay, for the, just now I mentioned that to fight off inflation, the central banks, one of the main tool they use is to adjust the interest rate. So this is what we call a yield curve, meaning that it is the interest rate across different maturity years. So you notice the blue vertical line that I drawn, and the word interest rate I written down there. So when the central banks increase and decrease the interest rate, they are mainly trying to adjust or trying to influence the interest rate for the short-term duration bonds, which is those within a 1-year maturity. Because under normal market condition, the further the maturity you go, the higher the return the investor will expect. Because if you were to invest for 30 years, you will expect a higher interest rate, to receive a higher interest rate, as compared to if you were to invest in only a bond that is lasting for 10 years or 5 years and so on. So thereby causing the yield curve to have such a upward sloping shape, right? But when the economy is in a turmoil, the yield curve will not be then moving in such a normal situation. So thereby, that's also one of the signals, one of the situation that you always often hear on the news about yield curve flattening, yield curve inverting, and thereby there's one of the worry that the economies or investing public may have is that that will signify coming recession, right? So this is a graph of yield spread between a 10-year and a 2-year treasuries on top. And then on the bottom, you have the GDP, which is the economy, or rather the 12-month change, the yearly change of the GDP itself. So the dotted line at the bottom of the graph, at the dotted line, as the blue line goes below the dotted line, which is 0, then it means that the economy is contracting. But we know by definition, it need not go into negative for it to be considered as a recession. As long as you have a downward sloping GDP growth for 2 consecutive quarters, it is considered as a technical recession, right? So you will see some correlation between the yield spread and the GDP growth. As the yield spread gets into negative is abnormal because, as I mentioned, the longer term, longer maturity bond, let's say the 10-year bond, is supposed to pay out a higher interest rate than the 2-year bond. But therefore, when you use the interest rate of the 10-year bond minus off the interest rate of the 2-year bond, this should always be positive. So if there are situations whereby when you do such sums and it becomes negative, then that's when the bond markets is not behaving normally, and thereby it could be a signal that we may have an impending recession. Okay, so the interest rate between countries are also different. So the interest rate difference, right, will then create opportunities for traders, especially currency traders, and that is what we call the carry trades, right? For example, if you look at Japan on the right, Japan has an interest rate of negative 0.1%. Right? Whereas in the United States, the interest rate actually now is about 1.5%. But at that point in time that this is being done is in March 2022, it was at 0.5%. So at current state, 1.5% versus the Japan minus -1, then there's a huge difference. So a lot of institution funds, they will then borrow from Japan, because when you borrow from Japanese yen, you pay a very low interest rate, and then you convert the yen into USD to invest into the US dollar assets. So by this action of borrowing yen and then selling yen, buying USD, then this will cause there to be a selling pressure on Japanese yen, causing the yen to weaken, and there will be a buying strength to the US dollar, right? So if one trader or one institution do it, then it's not going to matter much. But if more and more investors catch on to this trend, and they foresee that Japan is unlikely to raise their interest rate because they have very low inflation there, then more and more will take on to that action, and thereby further weakening the yen and further strengthening the USD. And that is exactly what we are observing right now when we observe the USD yen pair and we observe the Euro USD pair. The Euro and the yen are weakening over the past 6 months, whereas the USD has been strengthening over the past 6 months by quite a fair amount. And that is really because of the interest rate movement between these economies, right? Euro as interest rate is almost 0, right? They may try to raise it later on because they have a very pretty huge inflation problem there right now. But as of now, even if they were to raise it, they will still be quite far back from the US dollar interest rate. Okay, there's a question by Patrick. You asked about the counterparty risk. No, you are not trading against the broker here. In Phillip, we do not do the trade, but your trade will flow straight through to our counterparty banks who will be handling the trades. So as I mentioned, Phillip Nova is regulated by the MAS. So even though the product itself it is non-regulated, but the broker that let's say Phillip, we are being regulated. So yeah, so the counterparty risk here is pretty minimal. Just that as a product itself, as long as any product that is non-exchange traded, then they is always exposed to counterparty risk. Okay, so basically this is what is happening globally right now, and not what is causing the inflation and causing the currency movement due to the inflation, due to the government's actions to fight the inflation, and cause the huge movement in the currency among the major economies. Right. So how this government's action, be it fiscal or monetary policies, affect forex currency movement? So first thing first is the trade policy. Currency is mainly used as a conduit, right, as a payment to pay for the goods and services that we buy from over the world. So if a country is a net exporter of goods and services, then in that sense, that country's currency should strengthen, because the trading partner would then need to sell their home country currency. Let's say, for example, US against China. The US citizens who want to buy goods from China will need to sell US dollar, convert into yuan to pay the supplier back in China, right? So but even if they were to pay in USD, the supplier who received the USD would then sell the USD and convert it back to yuan in order for their own use, right? Unless maybe they may keep some USD if they need to do some other trading with other countries, but the major bulk of it they should probably want to convert back into their home currencies. So a country with a trade surplus would usually tends to cause the currencies to be strengthened, right? So this is just a flow of, as what I've mentioned, the flow process due to the trade surplus. But of course, the real world is not, again, not as simple as this. Take, for example, the US and China trade. Of course, we know that over the 4 years that Donald Trump was a president for United States, he has been constantly attacking China. And of course, one of the main grievances he had is that China had a huge trade surplus against US dollar, against the US. And that's really because that US is, I mean, per GDP, GDP per capita is a much stronger, much wealthier country as compared to China. But China being the currency is not freely traded, so it is quite controlled. So thereby, of course, then the Donald Trump, the president of the US at that time, wasn't very happy about this arrangement, and thereby started off some trade wars. So all these actions of the trades in the government policy will also cause that to will also influence the currency movement itself. As compared to a currency that is freely traded. Freely as in it moves purely by market force. But in this sense, government's actions may then cause it not to be moving in accordance to the market force. And as well as I mentioned, the interest rate policy, they may adjust the interest rate to fight inflation, or they adjust the interest rate to prop up the economy. And so the interest rate going up will then causes the assets of the country to be more attractive. Thereby, there'll be more buying pressure in the currency. And the reverse is true when the interest rate comes down. Okay, so out of this that I mentioned, I'm going to talk a little bit on the strategies part. When it comes to strategies to currency trading, the very important key is whether we are using technical or fundamental, is to only trade in the direction um, when the market gives you an edge, meaning that the market is set up for a certain kind of movement. So this setup can be you, you can have a gauge of this setup by doing some fundamental analysis or some technical analysis using charts. So fundamental analysis, as I mentioned just now, we talk about how the various policies, fiscal or monetary, will cause the movement in the currencies in the currency pair. So for example here, uh, we are the chart shown here is a monthly chart on the Euro USD pair, meaning that if the chart were to go up, it meant that the Euro has strengthened against USD. If the chart is to come down, it meant that the Euro had weakened against the USD. And at the bottom graph here, I've shown the um, the 2 years US dollar bond versus the 2-year euro dollar bond. So meaning that if this graph is going up, it meant that the US interest rate is increasing higher or more than the euro interest rate, right? So since 2005 until now, let's look at the first arrow here, the arrow in blue, right? From 2005 to the middle of 2007, this yield spread between the USD and Euro is coming down. So it means that the USD interest rate is dropping in comparison to the Euro. So that made the US dollar less attractive and it makes the Euro more attractive. Thereby, on the graph itself, you see that during the same period, the Euro USD had strengthened, right, from 2005 to the middle of 2007. So then later on, about 2008 to 2010, right, the yield spread has increased. Thereby, conversely, we see that the Euro USD has weakened. So on and so forth. You can look at a chart by yourself. You can see the comparison, and this thereby tells you that the interest rate difference between the currency pairs will cause there to be affects the movement of the currencies itself pretty directly, right? So if we know the policies, like the Fed has been pretty clear that they are increasing the interest rate. Of course, halfway through, if we see some change in the inflation rate, the Federal Reserve may then change their decision to either stop or start reducing if they feel that they have increased too much. But as of this moment, we know that they still have planned for another 2 more interest rate hike. July we have one, September we have another one. In fact, they are likely to increase the interest rate until next year, middle of next year. At least as of now, that's the plan, right? In between, on the last quarter from September to December, I personally think that there may be a pause in the interest rate hike because the US is coming to a midterm election. So usually the Federal Reserve may want to avoid increasing the interest rate because that will affect the sentiment. They do not want to be seen to be affecting the voting through the interest rate adjustment. So I think after the September increase, there may be a pause until after the election, perhaps maybe in December or next year. Then the Fed may resume the interest rate increase, especially if the inflation is still being very sticky, right? So as of Euro, uh, they probably will want to increase it, but they are being it's much more complicated over there in Europe because it is not a single country, right? And all of them got to agree. And different of the countries, their economic strength is different. So it's pretty hard for them to come into agreement whether they want to increase or they want to reduce it. So as of this moment, the euro may still likely to remain weak as long as we continue to see this yield spread. Okay, then second thing about government intervention, this is not something we can measure, but I think all of us, if we follow the news, we follow the global events, we roughly have a sense of what is going on. Take for example, this chart on the USD yen. The Prime Minister of Japan, ex-Prime Minister of Japan, who just passed away, when he came into power on the second term from December 2012 until September 2020, he especially at the beginning part of his term, he tried to implement some economic policy to spark off the Japan's economy, and he did succeed in a certain sense. So these policies that he implemented is widely known as the Abenomics. So basically, one of the key ingredient is for them to sort of weaken the Japanese yen, because prior to him coming to power, Japanese yen, even on the contrary that their economy is not doing so well, the Japanese yen was pretty strong. So through various measures, through various policy, he had managed to weaken the yen until of course Trump presidencies, and Trump at that point is not happy about any country trying to weaken their currencies against the USD, because he sees that as being affecting the Americans' competitiveness because their products are priced out of the market. So thereby you can see that since Trump's presidency, the Japanese yen did not continue north, or rather the USD yen did not continue northward until Trump was being replaced by the President Joe Biden. Then we see that the USD yen continue to strengthen up, meaning that the yen continue to weaken. In fact, about 10 years ago, when Abe first implement his Abenomic policies, I attended a talk whereby the economists at that time, sort of projected the USD yen to reach 140 levels. So of course, since 2017, when we see that the USD yen is struggling almost sideways, it almost seems that that target is unachievable. But as of now, we see that the USD yen is 130 over plus, pretty quite close to the 140 target that the economists had mentioned at that time. Okay, it's a question from Patrick regarding any specific reasons that I compare to a 2-year yield instead of 10-year yield. In fact, I wanted to compare the one-year yield, but I couldn't get the data. So the 2-year yield is the shortest one, because the shorter the maturity, then you'll be more reflective of the central bank's interest rate policies. Whereas the longer term one, sometimes it could be private investors actions, activities. They may also add on to influence on those bonds, as well as the QE, the quantitative easing, quantitative tightening. Usually these actions also affect the longer maturity bonds. So I will prefer to look at a shorter term one, to have a sense a comparison between the two economies' interest rate difference. Okay, there's a question from Mike regarding hedging of Hong Kong dollar. Sorry, I don't have any view on that because partly Hong Kong dollar is pegged to USD. So in that way, as long as the US dollar strengthen, the Hong Kong dollar are likely to strengthen as well. Okay, okay, there are two more setups to go through. One is on the commitment of traders report. Okay, I will not explain much on this, but probably just to mention to you that in the US, a lot of the large traders, they need to report their trading positions on the futures products. So even though currency trading is, as I mentioned, is OTC, is Forex, but under the CME exchange, they do have Euro futures, which is fairly traded on the volume is fairly large. So it is pretty good to use. So you can see that these COT reports will give you some indications on what the large traders are doing. So by definitions, large traders are those who trade 100 lots and above. So at one, every time they place a trade, it's 100 lots and above. So those are the, I mean, as in their positions are 100 lots and above. So those are the large traders. So large traders, they are generally viewed as being the smart money. So if they are buying, so it pays for us to take to pay attention. So what we are looking out here between the chart of Euro USD weekly chart and the COT large speculator is we want to see some divergence. If the price is going up, like for example, initially, if the price is going up over here, but the COT is showing a downward trend, did not follow it to go higher, then there's a possibility that the large trader are actually selling. So thereby we want to, if you are buying here, we want to scale down positions, or if you are looking to sell, it probably is a good time to look out for a breakout in trend. So similarly over here, price goes lower, but the COT is actually going higher. It will not happen all the time. Like for example, over here, COT agrees, the large trader agrees exactly with the chart itself, so we don't actually see any signals here. But on this part here, the price goes lower, the COT did not go any much lower, and so on and so forth. So for now, this is Euro USD. The Euro USD has weakened down to close to parity with US dollar. We are seeing some initial sign of the large speculator. Like they seems not to be going short much more than lower than last year. So it may not mean anything yet because this is ongoing. Maybe the next few weeks they may start shorting, right? So but as of now, I'll probably keep a watch out on Euro USD. The parity also may form some support. It is probably the third time that the Euro USD is coming close to parity. The previous two times it came and then it bounced back up. So I'm not sure if this time around it will bounce up or not. But I think since it has fallen by so much, I think it also pays to pay attention to it as we notice some signals from the COT. Okay, another oh, sorry. Okay, another indicator, this is technical indicator, it is called the average directional movement index, the ADX in short. Basically, ADX is a strength of the trend indicator. So, and as the ADX goes above 60, it usually signifies that the trend may be towards the end, losing strength, right? It does not tell you it's an uptrend or downtrend. But so as long as you see that there's a trend and the ADX is showing it going above 60, then we have to pay attention for a possible reversal, right? Possible reversal, reversal at various points whenever the ADX goes above 60. Right. So when you have markets that is set up, then we can before we place our trades, let's say we use the commitment of traders report, we use the ADX, we use the yield the yield spread between the currency pairs to determine the strength or the direction that we think that the currency will likely move towards. So then the next step we can do is to move on to a lower time frame chart, like if a daily chart or 4-hourly chart, and then we start to plot out the chart to look out for possible support and resistance level, and a possible weakening of the trend to look for an entry. So on the daily chart itself, this screenshot is taken from the MT5. So on the MT5, there's a pretty cool indicator as shown here, that right, it helps you to plot out the trend by automatically. So you do not need to like physically do the plotting. And what's good about this is that from the high point and the low point that the chart has plotted out, you can then spot out the possible support and resistance levels. And from there, you are able to determine the trend. Like for example, a trend, we know that for USD has been a downtrend. Also, on a technical point of view, it is in a downtrend because it keep on forming lower resistance, right? So take for example, just now we see that the COT report showing that possible that the large speculators may be buying, right? We should not jump the gun to go and buy it, but then we should start to watch out for a signal. So firstly, one way you can is by drawing trend lines. So when a trend line is broken, that is one possible entry level, right? Second possibility is that like when the chart stop forming lower low and breaks up, so this price action here is a possible signal for us to go buy on the Euro USD itself as well, right? And at the bottom you see accumulation and distribution line. So this is also an indication for us. By default, the accumulation and distribution line should agree with the trend, with the price trend, meaning that if the price is going down, we want to see accumulation and distribution line that is coming down as well. But if we see a price that is coming down, but accumulation and distribution is like failing to come down, this is one signal for us to watch out for, that hey, perhaps is coming towards the close of the trend, right? But as I mentioned, these indicators, they are lagging, so it could eventually come down and break lower following on. So so do not take all this as a signal to straight away go by, but in fact just take it as a further confirmation. Okay, on the topic of algo trading, I'm just going to quickly show you on the MT5. Okay, this is the MT5 platform. Okay, on the MT5 platform, we can you can either, if you know programming, create some set of rules, program it, and then you apply it to your trading. For example, over here, the chart I've shown here is a Euro USD 4-hourly chart, right? I have created this aspect advisor that I can then apply onto the chart itself, right? And then if you leave it on running, when there's a signal to go long or signal to go short, the system will then automatically buy and sell for you, right? But of course, it is not those active scalping trades, so you're not going to see a lot of buy and sell action based on the rules that I've set up. But I'm just going to show you quickly how it will look like on a backtest basis. Okay, so on this MT5 itself, you have a strategy tester, meaning that once you have created, or if you want to, you can also buy the trading strategies from the marketplace, the MT5 marketplace, and then you can also apply it for your own charting use. So, so either by creating your own or by purchasing a assisting expert advisor, you can then apply it, select your symbol, select the time frame, 4-hourly, and then click start. Okay, this graph here will show you the equity graph of this strategy, which I started the trade since the year 2000 until now. So the starting capital is 10K. So you will see that it starts to move. Now it's about 13K profit, 14K profit, and then at 2009. So as a system test, so if you are fairly familiar with programming, or you are fairly familiar with trading strategies, you can apply this into this MT5. Or if you are not familiar with it, you can then go to the marketplace to read up. So for my customer who are keen on this, I also share some of those strategies that I have created so that they can apply it or can test it out on their own system as well. Okay, it's a little bit slow, so we just leave it running here. So let me just see if you have any more questions. Okay, so one last thing for MT5, it is a zero-com basis. So any trades that you place here, the main concern you need to take note of is of course your entry price, exit price, as well as the swap points. Okay, so the test is completed. We can click on the back test tab to see the results. So the initial deposit is 10,000. The total net profit is 7,000. And then yeah, the maximum drawdown is 14%, and so on and so forth. So there's tons of data for you to analyze your trades. And then if you think that it's not good enough, then you can go to the inputs. You can do some adjustment, or then to try out to test it out as well, right? Okay, so this is my services for my clients. As I mentioned, I joined Phillip. I have a triple license. I have a license in stocks, futures, and forex. So depending on the client's account with me, they will receive some of these updates via WhatsApp and via email. So for stocks clients, they will receive more information on stocks. Futures clients, forex clients will then receive more information on futures and forex. Okay, so we have this ongoing promotion. If you are interested to open an account with us after today's seminar, within the next 72 hours, you can scan on this QR code to open the Nova or the MT5 account. And then if you were to, after your account is open, within the next 1 week, if you fund in $1,000 into the account, you will then be able to receive $50 trading credit within 2 weeks of the webinar, right? So I repeat myself, scan this QR code to open a Nova or Mt5 account. Within the next 3 days, within 72 hours. And once the account is activated, then within next 1 week, if you're funding $1,000, you will then receive $50 trading credit into your trading account within 2 weeks of this webinar. Okay, so this is my name and my contact in my QR code. You can scan if you want to arrange for a one-on-one session with coaching session to if you've got further questions that is not answered today. Right, that's all the time we have for today. Thank you so much for being a wonderful audience for tonight's webinar. A link to the recording of this webinar will be made available in our follow-up email tomorrow. If you have any query on the webinar or if you would like to get started, simply reply to our email and we'll get in touch with you. Okay, this is Eric Lee signing off. Have a good evening ahead. All the best.